All right, anyway, so we're going to do equity. Did you guys know there are assets, liabilities, and equity, and then revenues and expenses? Two types of equity that we had so far were contributed capital, different types, and retained earnings, and then there's really another one called other comprehensive income in between, and we mentioned that in chapter 5 just a little bit. That's where we put the stuff we don't know what to do with. When we get to the chapter on investing in other companies, stocks and bonds, and when we get to the chapter on investments, it's going to be, there's going to be gains and losses on available for sale securities, short-term and long-term, and we couldn't agree on where to put the gains and losses. We want to show those assets at fair value in the balance sheet, so we adjust from whatever you paid for it, historical cost, to fair value, because you know the fair value. If you own some General Motors stock, you can look up every day and see what the fair value is, right? And Continuing Basics or Young Brands or whatever. Same with bonds. You know what the fair value is. The problem we have is where do we put the gains and losses? Because nobody wanted to put the gains and losses in the income statement, because what if the stock market goes way down? You have horrendous losses. Gains they wouldn't mind, right? But it gives more variability to returns. There's a reason you don't want that variability in income and so on. So anyway, what the compromise was we put another comprehensive things. So there's a whole other category here that we'll worry about later. Right now, we're just doing this one and a little bit this one. You guys do know about retained earnings. You know what happens in retained earnings, right? Revenues less expenses, and there's also gains that are kind of like revenues, right? You know about those things now. There are expenses that are kind of like losses. Gains are like revenues, except there's no expense associated with it, right, guys? They're the non-operating stuff, peripheral to the business, okay? And the same thing with losses. Right? Right? If you have a loss, it's similar to an expense, except there's no revenues associated with it, right, guys? Okay, so the debits and credits work the same way. And then we have net income here, and that net income or net loss goes in here. If it's net income, it increases retained earnings. If it is net loss, it reduces retained earnings. You guys know all this stuff. It's kind of cool, right? We're getting places. And we got a beginning retained earnings for each year. When you start the company, of course, it's nothing. And then you add up all the net incomes all the years you're in business. You take away any net losses in the years you're in business. And then what else is there that comes into this thing? Dividends. Look at that. Dividends all the years. And then so if you look at retained earnings for a company at the end, that is the accumulation of what, of course? All the income they ever earned for the life of the company, less all the losses they ever had for the life of the company, less all the dividends they ever paid for the life of the company. Right? That's it. Now, there are going to be two types of dividends. There can be cash dividends, okay? It's one of them. And there's going to be stock dividends. What's a stock dividend? Instead of giving them cash, give them stock. Give your shareholders stock. Shareholders really want stock. No, they'd rather have cash. But when you give them the stock, they might be able to sell it and get some cash for it. Maybe. Okay? Or you might give them the stock, and maybe you have a policy. Every quarter we pay $1 dividend. Every quarter. We always have, right? We just do that. Okay? Company policy. And we'll talk a little bit about dividend policy in here, but not much in the finance class. We'll talk more about that. Personally, I don't care. Simply, when I invest in a company, I don't care if they pay me dividends or not. Cash dividends. Why don't I care? If they don't pay me dividends and I reinvest the money in the company, it'll make my stock value go up, right? If they make good investments. If they give it to me, what do I have to do with the money anyway? If I'm not retired, I'm going to reinvest it in something else, right? So it's kind of a pain if they give me the dividend. I don't want the dividend. And some people say, oh no, I want dividend stocks because my kids are going to go to college with that money. You don't have to have a dividend. You can just sell some stock and use the money to send them to college, right? You can get cash out of the stock whenever you want. You just sell the stock, right? But a lot of people do care about dividend policy. They think there's a signal in the dividend. If we give a dividend every quarter and we're always able to pay that dividend, it shows that we are a stable company. This is silly. Companies lose money, right? They have net loss, negative earnings per share. Got the idea, right? They have net loss, and then they'll pay a dividend. I think, what are you doing? You have a loss. Don't you need that money? So really the key is, as long as the people running the company, the management, have better investments, right, to make than I could make individually, don't give me the money. If you don't, what do I want? I want the money. You don't have anything to do with it, right? Well, this is a problem. Companies like Microsoft. Too much cash. Okay? I'm not kidding. They get too much cash, they don't know what to do with it. And what I mean by they don't know what to do with it is they can't find investments that will pay off as well as the investments they already have in the products they're already doing. So they can't expand fast enough, right? You have to figure out enough things to do. So then should they be paying dividends? Yes. And they finally started doing it, right? Okay. All right, anyways, it took them a long time before they decided to. Okay, so just the idea with this thing, you guys, get rid of this. Okay. The idea with this thing is we could have stock dividend, we could have cash dividend. Oh, by the way, why would the company do the stock dividend? They don't have any cash. They still want to pay a dividend. Make sense? Okay? So it's just issuing stock that replaces the retained earnings. And we'll learn how to do the accounting for this. Okay? But if you understand what they're trying to do, it's not a very big deal. Yeah?
How would you like break down stock?
Oh, great question. How would you do the journal entries? Did you read this chapter? How many of you read this chapter already? I know we just did a hard chapter, a few of you. Yeah. We just did a hard chapter. I didn't make a big deal out of reading this one, so of course you didn't, right? And by the way, are your other classes expecting you to do something at this point in the semester? Oh, crap. It's going crazy. I know. So keep working, though. Keep working. We're not speeding up, right? We're not slowing down either. We're just doing stuff, okay? So you're welcome for spreading it out evenly, sort of, throughout the semester. Huh? In fact, the last week, what are we doing in here? We're getting ready for the final. We're done with the material. We're doing it in 14 weeks instead of 15, so you've got some time to actually get ready for a final. Okay? So we kind of packed it in at the beginning, really. Relative to your other classes, did we? Pretty much, yeah. And do that for yourself now. Because most classes you're taking, they'll take their time and they'll get all fired up. And then by the end, oh my God, we're running out of time. And they go crazy. And plus, it's cumulative, so all your papers are due at the end. And it's legitimate. And all your tests are at the end. Most of the points, even in this class, are at the end because it's cumulative learning, right? Okay, but what you need to do for yourself is at the beginning of next semester, what do? Hit the ground running, right? Hit the ground running. Do stuff in advance. Do stuff early. Really pay off. But anyway, let's do some of this. His question was, what about stock dividend? Well, let's do stock dividends then. You want to do cash dividends first because they're really easy? Let's do cash dividends first. You already know sort of how to do them, okay? So I decide to declare, we have a declare date. You're going to read this in the chapter, okay? We have a declaration date we declared it. We have a record date. And by the way, on the stock dividends, we'll have these dates too, okay? So the dates apply in both cases. We'll have a record date, and then we'll have a payment date for a stock list distribution date. Okay? And on these 3 dates, we decide to do something, okay? So let's say that, for now, we'll just have common stock, and we're going to pay a dividend on common stock. And let's say we decide to pay a $100,000 dividend. So on December 1st, I decide I'm going to do a $100,000 dividend, okay? Board of Directors declare the dividend, okay? On December 15th, whoever owns the stock is going to receive the dividend, but they don't receive it until, say, December 30th. We pay it on December 30th, okay? Now, why do we do this? There are 3 million shareholders, or there are even 3,000 shareholders. I don't know who they are on the declaration date to write them a check. I have to figure out who they are. So I'm going to get the whole list of them, and I'll do that as of the record date. Got it? And then I'll send all those people the check on December 30th, and it gives me time between those dates to get the checks processed and to send them out. Got the idea? Okay, pay everybody. That's all it is. It's just not a big deal. It just makes sense. Okay? So that's supposed to be 15. Okay, so what happens? At the declaration date, I now have an obligation to give them the dividend. What do you think the journal entry should be? Let's say it's a $100,000 dividend. What should we do? What do you do when you do a dividend? What do we already do when you did a dividend? We debited an account called dividends, which is a temporary retained earnings account, right? Or we just debited retained earnings. Yeah, so either way. So that's what we do here. Debit retained earnings or debit dividends, right? For the $100,000. Got the idea? What would you credit? I'm not paying them. I now owe it. What is it? Dividends payable. Is this simple or what? Stuff you already know, isn't it? Of course. I declared a dividend. It comes out of retained earnings, of course. Either directly out of retained earnings or put it in dividends. And then at the end of the year, you'll close, before you start the next year, dividends into retained earnings. I can talk this fast now with you guys, can't I? And you stay with me. And you understand what I'm talking about. And I can write abbreviations. You know what they mean, huh? Isn't this cool? It makes my life really easy. At this point in the semester, it's kind of wow, we go. At the beginning, oh man, that was work. Okay? nobody knew what the hell I was talking about. Now you do, don't you? And if you really pay attention and you know, when you work and you keep your head into it, you can do this at work. Your boss is explaining something to you you've never seen before. You fit it with everything you already know. You know how to do it. Boom, you're on your way, and your boss is going to love you, right? Everybody's going to want you to work on their jobs, right? All the supervisors. Right? I want that kid. I want that kid. They pay attention. They focus. They put everything together, right? It just works. Everything I give them to do just gets done, and I don't have to worry about it. It's wonderful. They love supervising me. They never have to talk to you. It's fantastic. Huh? And when they do talk to you, you ask them a whole list of questions. They answer the questions. You never ask the same one again. Now you know how to do that too, right? So then they can have a beer with you and laugh about stuff. You know, talk about the 11-hour interview with Hillary Clinton yesterday. 11 hours. Oh man, a political grandstand. It's hilarious. I actually watched part of it because I don't have a real job anymore, so I have time for that. Okay, anyway, so all right, on the record date, you guys did that, I know. On the record date, what happens? Nothing in terms of journal entries. No journal entry. What does happen? We find out who we're going to write the checks to. Okay, now here's the deal. If you own the stock on the declaration date, you are not necessarily going to get the dividend. When would you not? If you sell it to somebody else. You own the stock on the declaration date, I buy it from you. I'm going to own it on the record date, I'm going to get a dividend check. So what would I have to do? I have to pay you for the dividend. So if in the Wall Street Journal or on Yahoo Finance, next to the stock name, it says X dividend, that means without the dividend. So what happens if I buy the stock from him, though, after the record date? He gets the dividend, I don't, I'll pay him less, of course. Got it? That's all it means, okay? So just understanding how things work. All right, so there's no journal entry, we just find out who we owe the money to, right, who the shareholder happens to be at that point. And then what are you going to do on December 30th when you write the check? Debit what?
Dividends payable.
Dividends payable, of course. I'm going to actually give you points for doing stuff like this. Isn't that cool? Okay, and credit what? Cash. Because it's new, it's different, it's something you got to know. Okay, ta-da, we're done with cash dividends. Okay, preferred and common would work exactly the same way. You could call it a preferred stock dividend payable, preferred cash dividend payable, and a common cash dividend payable if you want, right? Okay, so then let's say we don't have the cash and we'd still like to do a dividend. Okay, now this gets a little more complicated, right? Because there are two sizes for the dividends, and we do the accounting differently for the two different sizes. Okay, so let's do a stock dividend. Does anybody know from reading the chapter? Those of you that read the chapter, do you know the two different sizes? One's big, one's small, right? Like that. There's the small one, and there's the large one. Big, little, whatever you want. Okay. Did anybody pick up a percentage? Yes.
Isn't it for small less than 20 to 25%?
Yeah, less than 20 to 25%. I think this number makes no sense whatsoever. But there are a lot of things in accounting that I don't think make sense. I haven't told you that very much lately, or so far, have I? And I pretend like there's one way to do it. It's all right. Hey, come on, right? And this is people's judgment. I think we're figuring things out. It wouldn't be a profession if there wasn't judgment. We computerize it all. We program it all on the computer. A lot of people think you don't need accountants anymore because everything's programmed in the computer. Nah, that's bookkeeping. We don't need it anymore. It's not accounting. Accounting is the thinking part. Right? Sorry. Okay. Anyway, large. Actually, it's good because we can make a living. Right? Large. Guess what? More than. Less than. More than. So good. And 20 to 25% obviously is a rule of thumb, isn't it? I think it should be more like 2 or 3%. I really do. Don't do that, right? This is the rule that we use, okay? But I think it'd be about 2, 3, 4%. Here's the deal. What we're going to do if it's small is we think it is the same as if we had given them the market value of the stock. So we're going to record it at market value. You guys really are kind of fun because you can actually give you some theory here. Okay? Record at market value. Okay? I'm going to record it at the market value. Because I think when I give you these shares of stock, you'll be able to sell it for the market value. Well, that would, or then a large one, guess what we record it at? At par. Right? At par value. Okay? Record at par value. And the par value is an arbitrarily real low value. Okay? So, how many shares would you have to sell before the market value gets affected? You think let's say you got 100,000 shares outstanding, right? Oh, by the way, what are these things? Issued. First, I should say authorized. Issued and outstanding. What's authorized shares? For a company. Maybe I have 10 million of those. What would that mean? I filed articles of incorporation with the state, asking for permission to issue stock. Let's see. Any state in the union, there are 50 of them still, right? Any state in the union, right? Last came out, I was 59. Remember that? I think it was a big deal. So, we keep talking about making Puerto Rico a state. Maybe someday. Maybe there's a goal to make a state. For all practical purposes there. But anyway, in any of the 50 states, if you want to set up a business and you want to hire people and you want to generate economic activity, they're probably going to say no, right? No, they're going to say, please, please, please do that, unless you're a felon, okay? You know, if you've been swindling people or something, then they probably don't want you to start a business. But otherwise, yeah, sure, go ahead and do it. So what you do is you file articles of incorporation with the state, ask for permission to issue stock, and you tell them what your par or stated value is. So this 10 million shares, oops, not dollars, I'm sorry. This 10 million shares here is what? How many shares were authorized to someday issue to people, right? Okay, as ownership. None have been issued. Okay, and then we start issuing shares. Okay? When we issue the shares, let's say we have 1 million shares issued. That means we have issued them, sold them, I guess you could say, to shareholders, right? If we're starting a business ourselves, we issue them to ourselves, right? And we put our assets into the business. Cash, land, whatever we've got, right? Buildings, equipment, whatever we contribute to the business. Okay? So that would be issued. That makes sense, guys? It's just not a big deal. Okay? And we're going to record all these at their par or stated value. Okay? We'll come back to that in a second. Okay, outstanding is the ones that are out there being traded, right? Out in the market being traded. What could be the difference between issued and outstanding? Those of you who read the chapter, what is this stuff? Again, why you need to always read these chapters on, you know that, but getting into that something else. Okay? You got to discipline yourself over time to always come to meetings prepared. You never get quite to that point in your careers, right? But you always try. Okay? You guys came to the meeting, most of you came to the meeting unprepared, didn't you? And now you're paying for it, right? Again. And we do it again and again and again. Well, it's kind of nice if you're sitting there passively and you don't get called on the carpet for it every time you do that, right? But imagine you're sitting in a meeting with 5 people, and one of them's your boss. You're going to get away with not being prepared? Not if they're any good. They're going to ask you a question about what you're talking about, of course. Why would they have you at the meeting? And what will they do if you're not ready for the meeting? So you go back and do something else, you know, they didn't value there anyway. And then pretty soon you don't get invited to the meeting. After a while, you don't work there anymore. That kind of stuff. I mean, I'm not kidding, okay? Everything's this way, you guys, yeah.
Is outstanding the same as unissued?
No. Good point. It's not. By the way, if authorized is 10 million and issued is 1 million, how many are not issued? We'd call unissued. 9 million. That would be unissued. Okay, that's great. That's a great question. Great comment. Okay? Yeah, no, outstanding is something else. Outstanding is the issued ones that are no longer out there. Or, I'm sorry, some of the issued ones are no longer out there. So it'd be a number less than the issued, perhaps. Although a lot of times on the financial statements, they'll say 1 million shares issued and outstanding. That means what? What do we mean if we issued them and they're not outstanding anymore? What do you suppose we must have done? Bought them back. Oh, and what do we call those? Treasury stock. We got it. Okay. That's what treasury stock is, you guys. It's buying back my own stock. Oh, okay. So I might have 1 million shares issued and 990,000 shares outstanding. How much must treasury stock be? 10,000. You guys see it? So I got 10 million I'm authorized to do. I have issued to shareholders 1 million of those, and then I went on the stock market myself and I bought back 10,000 of the shares. The company can buy its own stock if it wants to. Can Yum Brands buy back its own stock? Sure. And companies do this, okay, from time to time. Why do you suppose you buy back treasury stock? Okay, a couple reasons. One is I just can't stand one of my shareholders, and I want to get rid of them. I'm management of the company, and I convince the other shareholders, right, the board of directors, at least of the shareholders, let's get rid of these people. Then we buy their stock, give them a good price for it, get rid of them. That's one reason. I'm not kidding, right? They're paying in your stock. Yeah, there you go. Okay, whatever. All right. Okay. Anyway, that's one. Another one is there's a hostile takeover attempt. Somebody's coming in and they're starting to buy up all the stock. And SEC rules, Securities and Exchange Commission, you guys read about, require that we report when we get to a certain level of ownership. We have to report to the SEC that we're buying the stock. Well, then the company knows that somebody's trying to do a hostile takeover. What do I mean by hostile? The current management doesn't want to lose their jobs. The current shareholders that have control don't want to lose control. And there are these people coming in who think the stock's a really good deal and they're buying it up and they're trying to take over control of the company, right? Hostile takeover. So one way you could fight a hostile takeover is something called green mail. And what you do is you give a whole bunch of money to the people who are doing the hostile takeover. And the way you do that is you buy their stock from them. So maybe they bought it for $100 a share and you give them $250 a share. And then they go away. They sell you all their stock all at once and they go away. Who really pays for that stock purchase? All the other shareholders, of course, right? How would you feel if you're one of the other shareholders? Somebody's trying to take over the company, get rid of inefficient management, they think, and put in their management, which might make you richer. Plus, if they're trying to take over the company, they might offer you a buyout, like just happened with Humana, right? The shareholders of Humana that own Humana are going to get, they're getting a lot more than it's been selling for in the marketplace, getting a premium on that stock. You think they want to fight that takeover? Probably not, right? If you don't have any control anyway in Humana, do you care if Humana gets taken over? And from an economic standpoint, do you care? We might care for other reasons, right? Antitrust reasons, competition, all that stuff. We might care for society, that sort of thing. Or if you have their insurance, which I do, right? I don't know that I want Humana taken over and my insurance premiums going up, if that's what happens, right? But over time seems to get oligopolies, right? Fewer and fewer. You know how many insurance companies are going to be left, big ones? There are 5 right now. There are 2 mergers going on. How many are going to be left? 3. 3 that have almost everybody as their clients for health insurance. Would it be more efficient if there was only 1? No, then the government would have to nationalize it. They would. Oh, so we don't want this happening too much, right? That's why we have antitrust laws. We don't enforce them very much, but that's where we've got them, to keep people from getting monopolies, right? This is certainly an oligopoly, isn't it? But by the way, there are thousands of insurance companies, thousands. They're just all real tiny. So then the question is, will it really hurt for there to be 3 that have, I don't know what they got, 60% of the business or something, maybe 70, amongst those 5 companies now, which will be 3. It's still a big chunk that's not them, right, that you could have insurance with. Of course, in some states, there's only those 3, or 1 or 2 of those. Oh, well, then that's a monopoly inside that state, right? And we have state laws that won't let people sell insurance, within the state without permission and all that. So, it's really complex. And anyway, so what is this idea of green mail? I take other shareholders' money and buy back the treasury stock, buy stock to somebody else. We don't like you, right? Or you're trying to take it to a hostile takeover. So we take the money and give it to you, get rid of you, right? Okay, so it's a real contentious thing, right? There are all sorts of lawsuits about it, right? All sorts of debate about whether or not this is ethical, okay? Anyway, so that's another reason. Another reason you might buy treasury stock is that you think your stock is selling for too low a price. You think the market doesn't realize how wonderful your company really is and what your stock should be selling for. And there's actually some evidence that occasionally this happens, that the company starts buying back their stock, like they decide to buy 10% of their stock back. And that, of course, drives up the market price because you're buying it out in the market. There's some evidence that sometimes it actually works, and the price stays up like that. But what happens most of the time when the company starts buying back their stock? Nothing, because it was appropriately priced in the first place, right? Okay? Another reason is you might have a whole bunch of cash laying around, you don't know what to do with it. What could the owners do? The major shareholders could do what? Buy out the minority shareholders by just going out in the stock market, buying out their stock, buy a whole bunch of it, right? Anybody who wants to sell can sell. Because of course you can sell your stock whenever you want, right? It's an organized exchange, you don't have to keep it if you don't want it, right? I don't particularly care which stock I own. I care how wealthy I am, right? I'm not running any of those companies, I'm never going to. They don't know who I am and they don't care. So when I put my money into an investment, right? They offer me a really good deal to sell it to them, what do? Sell it to them, I don't care, I'll buy something else, right? Take the gain. Okay, anyway. So that's treasury stock anyway. So we need to know, I was going to say par and stated value. Now some states have par, some states have stated value, and some states, these are values, and some states have no par, okay? All right, and I really need that before I do the stock dividends. Okay, so let's say we have $1 par. What does that mean? In my articles of incorporation, I specify that each share has a $1 par value, okay? Or 10, or 5, or whatever number you pick. Or the stated value could be $1 or 10 or 5. Some states have you do it in your articles of incorporation where you get permission to be a business, right? Okay, and issue stock, do business in the state as a corporation. That's par. Other states, they have stated values, and you don't put it in your articles of incorporation. You just hold a board of directors meeting, and they establish a stated value. So it's easier to change that value. You don't have to do amended articles of incorporation to read about the chapter. Okay. All right. Anyway, no par means they don't have par, right? This is going to change the journal entry. Stated value and par, when you issue the stock, are going to work exactly the same way. No par, you don't have to worry about the par value. Got it? Okay. So maybe what we'll do first is do an issuance of stock. Let's issue these 1 million shares, and let's say that we issue the 1 million shares. Let's say it's at $1 par or $1 stated value, either way, right? So it's $1 each one. So what am I going to record for that? A million times a buck. But let's say the market value at the time we sell them is $10. Okay, got the idea? I'm going to issue the stock for $10 million, and we can make it cash, land, building, and equipment, any asset you could debit, right? But it's going to total, I guess, if it's 1 million shares, $10 million. So let's do that. Okay. Let's record the stock. What will we do at the date that we issue the stock? Let's say we sell it for cash. How much are you going to debit cash for? You know, 1 million shares at $10 a share market value, what would it be? 10 million. Got it? Okay? What would we credit? If it's par stated value of $1, it's going to be $1 million in what? Common stock. No kidding. What if it's preferred stock? Call it preferred stock. Big deal. Although usually there the par will be $100 or something. Okay? Got the idea? No kidding. What's the rest?
Additional paid capital.
Yep, that's it. This is too easy. Additional paid-in capital, paid-in capital on common stock. Or if it's preferred stock, additional paid-in capital on preferred stock. Got it? Big deal. It's another equity account. So now you have, I told you there aren't very many equity accounts. Here's another one, right? Treasury stock's going to be one of them. Got the idea? What if it was no par stock? You wouldn't have additional paid-in capital. You put the whole thing in common stock. You just debit cash for 10 million, credit common stock for 10 million. That's it. You'll see that sometimes. Some states don't have par values or stated values. Okay? Got it? Everything's recorded at par or stated value. Okay? This is the easiest. Okay. Good. Well, while we're at this, let's do the treasury stock. I'm going to come back to your stock dividend, I promise. Oh, by the way, could this have been debit equipment, debit land, debit building? Yeah, who cares, right? Whatever the asset is that you got for it, right? Owners could contribute a building for the stock, couldn't they? Or inventory for the stock, or whatever they have for the stock. Got the idea? Equipment, so, yeah, big deal. Debit the asset, credit stock for that. Okay, let's buy back, what did I say, 10,000 shares? And let's say by the time we buy it back, the value is no longer $10. Now the market value goes up to $11. Because the market value will be changing, right? Going up or down, right? Or both. You know, wandering around. Okay, good. All right, that's how markets work. So let's say at the time that we buy back this treasury stock, okay, this is issue stock. It's an easy chapter. We buy back the treasury stock. What do you suppose you buy it with, of course? Cash. Okay, you're going to buy it with cash. All right, and we're going to buy 10,000 shares. What did I say? The market value is $11. Of course, it's going to be for the market value. We'd sell it for you, so not to you for less than that, right? Probably not going to pay more than the market value. Just go out to the market and buy it. Okay, so how much is that? 110,000, is it? Okay. So now what I've got is outstanding shares. Issued and outstanding shares are how much before I do this? 1 million shares, right? Everybody agree with that? What would I have in my common stock account, my equity? $1 million. What would I have in my additional paid-in capital, my equity? $9 million. What would be my total contributed capital? $10 million, right? You just made that happen with those journal entries. Okay, cool. All right, so what would the treasury stock look like when I buy it? Let's buy it. Let's buy the treasury stock. Credit cash, don't you suppose? How much? 110. What do you want to debit? Okay, this is the cost method. There are other methods, market value method. Okay, so what we're going to do is we're going to debit an account called treasury stock. Now here's another new account, and you need to know what kind of an account it is, don't you? Don't you think every time you see a new account, you got to know what it is? You figured that out, right? I told you that over and over too. But I bet you figured it out on your own by now too, huh? Debit treasury stock, credit cash. What kind of account is it? It's tempting to think I'd say what? Well, it's got to be like a contributed capital account. It's got to be an equity account. But I think it's tempting to think it's an asset because you debit it and you kind of invested in it. But can you invest in yourself? I'd be really rich if you could do that, you know. Right? You know, it's sort of like goodwill. I could establish lots of goodwill, debit goodwill, credit, equity, keep, you know, $100 million on a $100 millionaire, right? Why not? You know, paper. You can't buy yourself. Make sense? So when you're buying back this stock, what are you doing? You're reducing your equity. So yeah, it's an equity account, but it's got a debit balance. So what kind of an equity account is it? Contra equity. Got it. That's it. So that's a contra equity. So what you're going to do is you're going to show your paid-in capital, preferred stock, additional paid-in capital, and preferred stock, common stock, additional paid-in capital, and common stock. All that adds up to your total paid-in capital. Then you're going to add your retained earnings to that, right? And then you're going to subtract your treasury stock. The last thing in the equity section will be subtract the treasury stock. Okay? That's it. Okay? So this debit balance is going to reduce your equity. Got it? Everybody with me on this? Okay? It's just not a big deal. All right? How many shares are outstanding now? This was 1 million shares issued, right? So we're going to still say 1 million shares issued. Because they're still issued. I'm just holding some of them. So how many are out there? How many are outstanding? 1 million less 10,000. So that's where I got my 990,000 shares. You like it, guys? And that'd be the journal entry to record it. Okay? Fine. Everybody good with that? So which shares do you care about? The ones that have been issued or the ones that are outstanding? Outstanding. Which ones are you going to pay dividends on? Are you going to pay dividends on all your authorized shares? No. In this case, 9 million of them you have yourself. What are you going to write yourself a check? It's ridiculous. Okay? Are you going to pay dividends on the treasury stock? You're holding it. What are you going to write yourself a check? Of course not. Which ones are you going to pay dividends on? The outstanding ones, which is the 990,000. Everybody got it? So when we start doing a cash dividend or a stock dividend, who are we going to give it to? The outstanding shares, right? Of course. Stock splits are different. There's stock splits too, okay? So there are a few things in this chapter, aren't there? Okay, so let's go back to this thing then, and let's finish up treasury stock a little bit. They only show you one of these in the chapter. I want to show you two different ones. A little more sophistication, I guess. Let's say we sell some of our treasury stock. The reason we bought it was to get rid of a shareholder, right? And now we sell it out in the market again. We go back out. So let's say the first thing we do is we sell off. So here we bought 10,000 shares. Let's say we sell 4,000 of them. says sell, okay. Anyway, we sell 4,000 shares, but by that time, the market price is $12 per share. Could the market price go up and then we sell it? Of course, right? So what would you do with that one? I'm going to sell them for cash, guys. This is real hard. 4,000 shares for 12 bucks. What do I get? $48,000. Okay, so let it be common sense. What do I give up? Treasury stock, right? So the treasury stock goes away, which means what? How much? Oh, be careful. You bought them for how much a share? 11. So what should you retire them at? 11. It's $44,000. Don't take the whole 48 out of there. That makes no sense, right? Cost method. You get the idea? It's cost. Okay. So what do I now own? 110 less 44? What's that? 66 for the other 6,000 shares, right? I bought 10 and I sold off 4 of them, right? Now the market still owns 6. So my treasury stock account would still have, right? How much in it? 44 away from 110, 66, wouldn't it? Everybody good? Everybody staying with me? Okay? All right, but what else would I have? What's that other 4,000? Well, here comes another equity account. There are several of them, right? What's this going to be? More additional paid-in capital. Additional paid-in capital from what? Treasury stock. Ta-da. Is that common sense or what? It's where it came from, right? So now you have additional paid-in capital on common stock, and you might have and preferred stock maybe, and you might have additional paid-in capital from treasury stock listed in your paid-in capital. Okay? So now let's say that I sell off the other 6,000 shares, but it's too bad. The bottom fell out of the market, and they're only worth, I don't know, $8 per share market value. Oh, well, this is crappy. Yes.
Is your treasury stock 44,008 or just 44,000?
Just 44,000. It does look like an 8, doesn't it? Sloppy. Just 44,000. Thank you. Yeah. Debit 48,000 cash, credit common stock 44, and credit additional paid capital. Treasury stock 4. Okay, good. Okay, what's this one going to be? All 6,000 got me $8. How much is that? Is that 48,000? I didn't do that on purpose. It is, right? Okay. And then what? How much do you want to credit treasury stock for? Yeah, it's got to be 66 because you sold it all off. Everybody see where that comes from? That's 66. Okay. Why is it 66? I had 110 that I bought, right? Assuming I never had any before. And then I sold off 44 of them, that left 66. So if I sell the rest of them, the whole 66 is gone, right? But wait a minute. I debited cash 48, credit treasury stock 66. What else do you want to debit? I have an additional paid-in capital account with how much in it? This is my first transaction of treasury stock. Only 4. How much am I able to debit that for? Only 4. You can't have a debit balance in additional paid-in capital. It would mean nothing, right? Negative additional paid-in capital. Okay. So the additional paid-in capital on treasury stock goes away with 4,000, and that's only 52, but it was 66. I have to do something with the other, how much is it? 14,000? What am I going to do with the other 14 grand, you guys? I don't have any place to put this. So here's the rationale. I think what happened, I guess, was I wanted to get rid of those old shareholders. That's why I paid that price for it. Okay? And I like these new shareholders, I guess, or really just market value went down, right? But I must like these new shareholders enough to give some of our retained earnings to them to get them in the company. I guess that's sort of the theory. We go to retained earnings because we don't know where else to put it, basically. Okay? Got to put it someplace. So my equity is going down. So what's happening is I'm reducing my treasury stock, which increases my equity, right? By reducing the treasury stock, that credit. But then I'm going to record the cash, right? But the cash is less than the treasury stock, so what's going to happen? Well, my additional paid-in capital can go away to the extent I have any, and after that, it hits retained earnings. Got the idea? I am going to debit retained earnings. So, let me ask you this. Is there a gain on selling your treasury stock? What did we do the first time we sold some there? We credited additional paid-in capital on treasury stock. Why didn't we credit gain? You can't have gains and losses on issuing your own stock, buying back your own stock. Again, makes no sense, right? Okay? And then on the last one, is that a loss? Well, maybe economically it is. You bought it for $11 and you sold it for $8. There's an economic loss there. But do we call that a loss on our income statement? No, because it's transacting business with ourselves, right? With our shareholders. You got the idea? Everybody good with this? Not a very big deal. I'm going to give you points for being able to do this stuff, so being a generous guy like I am. Okay, so let's go back. Where were we? We were going to do recording. We're going to record small dividend and large dividend. And let's say, let's just say there are 1 million shares outstanding. Let's just say there's 1 million shares outstanding for both of these, okay? It's 1 million shares are outstanding. Everybody got the idea? You know what outstanding means now, don't you? Okay? Even if you didn't read this, you know, right? 1 million shares outstanding. Let's say the par value is $1. By the way, we keep the pars real low. Remind me in a second. We'll talk about that. The par is $1, and let's say the market value is $10. Okay? And let's say here we do a 5% dividend. And what I'll do is I'll make the dividend either real small or real big, okay? So you can tell them apart real easy. I won't be between the 20 and 25. So it's a 5% dividend. Everybody got the idea? This is a stock dividend. 5% stock dividend. Everybody good? Okay, and over here, let's say we do a 30% stock dividend. Got the idea? This is going to be real easy. All you have to remember is that if it's small, we think the market price is not going to change, so therefore we record it at market price. I think even with a 5%, I bet it goes down, but you bet. 5% more shares out there, there are no more assets in the company, just as many liabilities as before. What do you bet the market value goes down? Yeah, they will. Okay, that's why I think it should be 1 or 2% or something for this to actually work. Okay, on the large, do you think the stock price will adjust if it's 30% more shares of stock out there? Of course, it's going to go down, right? Proportional. Okay, anyway, what we do is we record at market value if it's small, and at par value or stated value, whichever state you're in. Okay, for a large one. Okay, cool. Okay, so what would be a 5% dividend? There's 1 million shares outstanding. What's 5% of that? How many shares is that? 50,000 shares. How many shares would be on the large one? 30%. 300,000, right? Everybody agree with that? 1 million times 30%. This is simple, okay? I'm going to record it, though, at market value if it's small. So what am I going to debit retained earnings or stock dividend for? How much? 50,000 times what? The market value of 10. That's 500 grand. You got it. Man. What am I going to credit? Common stock for how much? Not 500,000. Only 50 because you always record it at par. When you're issuing it, you record it at par, right? If somebody was buying it with cash or equipment or something, right? A new shareholder. Okay. Well, we recorded at par if we're doing a stock dividend too. Got it? Okay. So this would only be 50,000. So you got a debit of 500,000. That's the credit. Okay. You got a debit of 500,000 to retained earnings or stock dividends, which is a temporary retained earnings account that you would close to retain earnings, right? Okay. All right. Just like income summary. And then this is going to be additional paid-in capital on common stock, just like they had paid cash for it, for $450. How much is the additional paid-in capital per share if the par is $1 and the market value is 10? It's 9, right? 9 times 50,000 shares is the $450. Got it? Okay, what are we going to do if it's a large one? This is simple too. It's going to be at par or stated value. So the debit to retained earnings or stock dividend. You can call it a common stock dividend or preferred stock dividend if you want, right? Is how much? 300,000 shares at what? $1 par. So that's going to be 300,000. Everybody got the idea? And what are we going to credit for 300,000? Just common stock. There is no additional capital. Got it? Easy day-to-day, isn't it? It's kind of nice stuff. Okay? I mean, you don't got to know it. You're going to see it in the financial statements. Here's why this is kind of important for you to know. This par value is usually very, very small. So if you were to look at the equity section for this company that we just did, look what's going to happen. You're going to show common stock. If it's $1 a share and there were, what do we have, 1 million shares? It's going to be 1 million, right? And then we just did the dividends, so it'd be 1 million what if we did that? How much did I just do? I guess I need to know which one. Let's do the big one, okay? So it's 1,300,000, isn't it? Is that right? Mm-hmm. What would be additional paid-in capital on the common stock? I originally issued them for $10 a share. That's what we issued them. Okay? So what would that be? There were 900,000. There were 1 million shares outstanding issued, right? So that was 9 million, right? So 1 million for par. Yes, we did. Okay? So when you look at this statement, look what their paid-in capital is. Paid-in capital. 10,300,000. Which number is really meaningful to you? The par value here, or stated value, the additional paid-in capital, or the total? That's the total package, right? This is how much that the owners contributed. So when you look at a financial statement, it looks real complex in an equity section. It's not. Okay? Why do we have this dollar par thing anyway? When you issue your articles of incorporation, you might say I have a dollar par, but then you start doing stock splits. As your stock price goes up, you'll do something called a stock split. So let's say I issue the stock and it's $1 par, okay? But the market value is really $10 when I issue the stock, which is exactly what we just did. Why would we do this? Here's where it came from historically, because it seems really strange. Why would anybody do this? Let's say I were to start a business, okay? And I invest $100,000 in the business. I'd have $100,000 of assets, cash, right? And I would have no liabilities, and I would have equity of $100,000. Everybody with me on this? Then I go to the bank and I ask them if they'll loan me money, or creditors in general, right? Lenders in general. And I say, will you loan me some money? And they say, well, how much money do you have? I say, I put in $100,000 of my own money. And let's make it simple. Okay, I'll give you $100,000. I'll loan you $100,000. So what would I do? I'd debit cash for $100, and I have $200,000 of assets, right? I'd have $100 of liabilities, and I'd have $100 of equity. Everybody staying with me? That'd be my new company now. Okay, then what I do is I pay myself a dividend of $100,000. Equity becomes 0. Liability stays 100, and assets are 100. The people who loan you that money, are they happy? The reason they gave you the money is they were taking 50% of the risk in the company. You took yours out now. You had 100% of the risk, right? There's only your money in. Then they put in 50% and you still have 50% of the risk. Now you take your money out, they have all the risk. So what happens is, let's say I'm paying 10% interest. Anything I make more than 10%, I get to keep. And I have no investment whatsoever. Nice deal, huh? If I make less than 10%, I just declare bankruptcy and it's their problem. Got the idea? People actually did this stuff. So we passed laws that said, years and years ago, that you have to keep a minimum capital in the company. You can't pay dividends that take you down below, guess what the law says in most states? Par or stated value. So par values used to be real high. But why would you make your par value high? It limits you being able to take dividends out, right? So what they did was they made the par value $1, even though the market value might be 10. So now what do I have? If I have 10 million in equity, right, contributed capital, only $1 million's par value, 9 million is additional paid-in capital. I can still pay myself the 9 million dividend. Got the idea? But you just read about bonds payable, didn't you? Remember the covenants part? I didn't talk about it, but you read about it, right? Covenants. What's the deal with bond covenants? Well, if you borrow other money, right, you have to repay us first, or that debt is subordinate to ours, which means we get paid before they do. If you want to pay dividends, you have to get our permission. You have to keep a certain current ratio, current assets divided by current liabilities. It has to be higher. They sort of tie your hands, right? So because this didn't work to stop people from ripping other people off, basically, right? What happens? Taking advantage of other people. What happens? We have all these bond covenants to protect the bondholders. You can write the agreement any way you want. By the way, if you put restrictions into the bonds, you have to pay a higher interest rate. Less restrictions, less interest rate. Did that kind of make sense, guys? Okay, so that's where this par value thing came from. Let's do a 10-for-1 split. Give me 2 more minutes. Let's do it, and I'll take less time next time, okay? Deal? Okay. Anyway, I'm lying probably, because I'll forget. Anyway, have questions for me next time on stuff we didn't cover in this chapter. There's lots of stuff in this chapter. What do you want to go over? Anyway, let's do a 10-for-1 split. Let's say I have this situation, guys. Let's say I have 1 million shares, right? Authorized. Let's say issued are 100,000, make our life easy. Let's say treasury stock is 10,000, which would make outstanding how many? You issued 100 and then you bought back 10. It's 90, isn't it? Okay, and let's make my par the $1, and let's make my market value the $100. And the reason I want to do a split is my market value got real big. And for some reason, psychologically, people do not want to buy stock if the market value per share goes high. They'd rather own 1 million shares of a stock that's $1 a share than $1 million worth, right, of stock that's $100 a share because they own so many fewer shares. This doesn't mean anything. It's stupid, right? We're kind of that way. But the reality is, you don't want your stock to be $100,000 a share, right? Nobody can buy a share, okay? So when it starts getting above 100, they tend to do splits. Let's do a 10-to-1 split. So this is now. Let's do a 10-to-1 split. And all you have to remember on splits is there is no journal entry. You don't need one. No journal entry, okay, guys? So I'm going to probably ask you, what's the journal entry for a split? What are you going to say? Nothing. You don't do it. How many shares will there be if I have 10-to-1 split? All the shares that are out there, right? All the shares that exist, authorized, issued, treasury stock outstanding, all of them, everybody who has 1 share is going to get 10. That's a 10-to-1 split. 5-to-1, they'd get 5. Got the idea? Easy. Okay, so how many shares will there be authorized? If it's 10 million, or 1 million now, and there'll be 10 times as many now. You have to file new articles of incorporation, and believe me, they'll let you do this, right? Because they want your business to grow. So now there's 10 million. How many are issued? I get back all 100,000, and I give every shareholder that owns a share 10. How many do I have? 1 million, of course. Still 10% are outstanding, or issued rather. Still 10% issued. If there were 10,000 treasury shares, how many do I give myself? 10 for each one. What's it going to be? 100,000. So obviously 1 million less 100 is what? That was not dollars. Okay, right? Shares. Okay, then what? 900,000. Everybody agree? See, it's all just 10 times as many. Each of these are shares. Each of these are shares. Now, this is where it changes. What's your par stated value going to be? There's no journal entry, guys. How much was in the account contributed capital, or common stock, rather? How much was in the account common stock? 1 million, or 100,000 shares at what? $1. So it's $100,000. Still has to be $100,000 because there's no journal entry. Oh, if there's 10 times as many shares, what's going to happen to the par? It's going to be 1/10 as much. It's going to be 10 cents per share. You will see par values that are a penny, that are 1/10 of 1%. How does that happen? Over the years, they keep doing stock splits. You do enough 10-to-1 stock splits, right? We're already down to 10 cents. We do another 10-to-1, it's down to a penny. Got the idea? That's how that happens. So you'll see that, and it means nothing, right? What is the balance still in common stock? If there's 1 million shares at 10 cents per share, how much is it? $100,000. How much was it before? $100,000, right? No journal entry. Got the idea? Okay, and treasury stock. Would we make a journal entry for the treasury stock? No. If you bought this treasury stock, let's say we bought it for $9 a share, it'd be 90,000. Now you got 100,000 that are 90,000, right? So they'd be 90 cents each instead. Okay, big deal. Is that easy or what? Now tell me one more thing and I'll let you go. Market value. What's going to happen to it if you have 10 times as many shares? It's $100 now, what do you think it'll probably go down to? About 10. Now, there are other things going on in the market, of course, so it might not be exactly 10, right? Everybody got it? See you. Wasn't this a nice, easy day? Glad you came for a Friday, right? I was looking forward to it, kind of, after Bond Street. Okay, it's going to get hard again. Sorry. What's the chapter after this one? Is that the appendix?
Here's chapter 12.
There's 12.
What is 12?
12.
What is 12?
What is 12?
Yeah. What's next?